Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, what this means for us as retail traders is that we can actually take advantage of that expansion in a condition where volatility, implied volatility, is considered to be relatively low, and we can take advantage of an expansion in volatility as the anticipated move begins to get factored into the option contract. So it's important to look at creating a straddle or a strangle using options that would be considered, I guess for lack of a better word, cheap, looking to take advantage of that expansion in volatility along with a potential move in the underlying security. The reason why we need to be considerate of this, of course, is because we are actually going to be purchasing a call and a put option, so the cost of the transaction is doubled, and therefore we need to make sure that we're not overpaying for those option contracts. And now, when we consider the importance of timing our entries for these particular strategies, the lower cost of the option gives us, as the option buyers, in other words, buying a call or buying a put, a chance to capitalize not only on an increase in that implied volatility leading into a particular event or a particular movement, but also a significant, also a significant price movement in the pair value. So in other words, we're taking advantage of cheap options, making money when the value of those options expand from an implied volatility perspective, and we're also taking advantage of a significant price movement in one direction or another. Now, this is just a snapshot that I took yesterday of a page off of the fxoptions.com site. So you can see that we have a nice little chart. In this case, we're looking at the CDD right in here, and you can see that we have a nice little price chart, and we have a couple of moving averages in there. There's below here is a little oscillator that is reflecting the implied volatility versus the historic volatility. And what I want you guys to pay attention to here is the information that we see in these two middle boxes. So you can see that the implied volatility, this is what the IV stands for, implied volatility, is actually sitting at 11.20 right now. If we look at the 52-week high with respect to the implied volatility, we can see that it was upwards of approximately 20% at one point. So we could look at this reading here and determine that option premiums from a historical perspective are relatively cheap compared to where they were. We can compare the historical volatility of the underlying security as well, in this case the CDD, and see that implied and historic are relatively close to one another. So this offers an ideal environment from an options pricing perspective to establish a strategy that embraces the idea of buying both a call and a put option. Now, you can see down here we have implied volatility in orange, and we have historical volatility in a blue color. And really, when the two lines are essentially together, it's really suggesting to us that the options are priced fairly based on the past historical price action or pair value action in this case in the security. So we would be looking at taking advantage of a scenario where whereas you can see here, the implied volatility versus historic volatility are relatively close, and we would look to take advantage of not only a similar price movement that we see here in the actual pair, but also an expansion of volatility as well. Now, to look at that a little more closely here, I've just clipped a shot of the the implied volatility chart or the volatility chart that you can get through the Options Express platform. And once again, you can see that based on, and again, this was yesterday's reading, implied volatility versus historic volatility are relatively close to one another. So the idea is that if we were looking at expecting an expansion in volatility as well as a significant move in the underlying pair value over a certain period of time, this would be perhaps an interesting time to consider that type of a trade. So let's look at establishing what is known as a straddle. Now, these are very simple strategies that any retail investor can implement. So they're not difficult to understand. They're not difficult to establish, but it does require some thought as to whether or not it's an appropriate time to implement. So the construction of a straddle involves the purchase of both a call and a put option at the same time. We're looking at creating that particular position surrounding the same pair value at the same strike price. Now, that's the reason why it's referred to as a straddle. Think of straddling something. You're essentially on it when you straddle a fence or something to that effect. You're essentially on the same spot. So in this case, this particular strategy is referred to as a straddle because we're in fact using the same strike price. Now, in this example, we're going to talk about utilizing the same expiration month as well. But I want you to keep in mind that you don't just have to limit yourself to implementing this particular strategy using the same expiration date. What we've been very successful at doing is really applying the same rationale, the idea of buying a call and buying a put option. But let's say, for example, we're longer-term bullish. We would buy a longer-term call option at, say, a 100 strike on the CDD, and then we would look at buying a short-term put option to hedge the downside at the 100 strike, just looking to offset some possible immediate variance in our expectations and capitalize on a short-term move, offsetting some of the cost of that longer-term call option and moving forward. So I want you to just remember that you can, in fact, create this strategy when you have a particular directional bias. Now, Stephen just had a question. Can we comment on how we can predict the idea of expanding volatility in any particular currency pair, or is it linked to the VIX? Well, it's not linked to the VIX. The VIX is really a reference to the equity markets and really a look at implied volatility in S&P options. But what we can assume with any of these particular pair values is that they have an average price or historical volatility that they in fact will more or less adhere to. And typically, as implied volatility begins to trade along the lines, the same lines as historical volatility, it's showing us that the market, or essentially that options are priced fairly, and that there is really, options are, I wouldn't say underpriced, but priced based on past historical moves. But if from a technical perspective you were looking at a particular pair value, a currency pair, or there was some sort of an economic announcement coming out moving forward, one would assume that as we got closer to that announcement, you would see volatility expansion, so expanding. And so what you can do, again, looking at the CDD and anticipating, and we'll look at this a little more closely, but in anticipating that really those options are quite fairly priced, one would look at the past historical volatility of the stock and look at it in such a way that there's a high probability that volatility is going to expand and that we are in all likelihood going to see a potential move in one direction or another over the next certain period of time.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.